Hello everyone, welcome back to the channel. Today we're going to discuss about a company called 361 WAM. While this company name might feel a bit unfamiliar, bizarre, this company actually is the IIFL erstwhile IIFL Wealth, right? So this is a 17-year-old company, and we're going to talk about this company and looking to the latest quarterly to quarter two FY26 numbers. And like all my videos, this video is also channel disclaimers are there. Like this is an education purpose video only, and this is not there is no buy and sell recommendation from my side. This is just me analyzing public information and decoding all the information for you. So let's look into the company overall. The company is operating for the last 17 years. The irony is that this is a wealth management and asset management company currently, catering to the ultra rich Indians. The irony is that this company started operating from January of 2008. So this was the starting of the great financial crisis. So not the best time to start a wealth management company for sure. But the company was resilient, and I think it has done very well. It is probably one of the largest wealth management companies in India right now. Overall, in the 17 years of history, key milestones has been that, like let's say, they have strategic investors like Great Atlantic or picked up 21% stake there. Other than that, in the year 2019, this got listed in the Indian stock market exchanges, demerging from the IIFL group. In the year 2022, they rebranded himself from the IFL Wealth to 361 WAM, showing the overall focus on the holistic wealth management and asset management services. Recently, they had grown organically, looking into products like AIF, mutual funds, distribution, lending, broking, and inorganic, like let's say acquisition. For example, one recent example is that they recently acquired the UBS India Wealth Management Group, for which they got the book of around 30 billion rupees, so 30,000 crore, for 5% stake in the company. So this is a recent transaction. Now coming to the crux of the matter, coming to the quarter two numbers. My focus is that not just the numbers, but also how do we really analyze the numbers, right? So whenever I talk about any wealth management company, asset management company, typically the first number typically comes to our mind is the AUM, the asset under management. So this company currently, as of 30th September 2025, manages 7 trillion rupees. So sounds a lot, right? But we have to dig a bit deeper here. So we divide it typically for this company. We typically divide the AUM into two parts. First part is the ARR revenue, so which is the recurring revenue. So typically, out of the 7 trillion, 3 trillion, like 40% of the AUM belongs to the ARR part of it. Basically, so from this 3 trillion rupees, this company makes revenues year after year, right? That's the good advantage of it. The rest of the 4 trillion rupees is the non-AR part. So mainly, let's say, broking, syndication, and all those lending from all those parts. So that's a division. Now coming to the numbers for quarter two, quarter two, we have the annual revenue around operating revenue around 763 crore, which is a whooping 30% growth year on year. Sounds great. Then breaking up this number 763 crore into two parts. One is the ARR revenue. The ARR revenue comes around 554 crore, and the transaction revenue comes around 209 crore. So if I do a breakup, typically of the operating revenue, typically 73% is the revenue from the ARR part, and 27% the transaction part. But if you look at the AUM, 4 trillion rupees basically for this overall quarter is producing a revenue of 210 crores, like, approximately, and 3 trillion of recurring part is producing around 550 crores of revenue. So you do see that not just this revenue is repeating, but also the higher percentage. So the next is that there are a few important metrics we typically use to analyze the numbers. The metric is that ARR retention, which basically means that for each 1 rupee the companies and asset management companies managing, how much of it is able to retain as from revenue, right? So typically, so currently you can think of, on the flip side, something that the TER, the total expense ratio for mutual fund. So let's say typically the for any active equity active mutual funds, the ratio can be, let's say for direct funds, can be from 0.5 to 2%. What does that mean? That for every 100 rupees the investor is giving, how much money is the expense ratio of like the money required for the asset management company to manage that money. So typically that number is around 1% for most companies. For for 361 WAM, for the quarter two numbers, that ratio is around 76 basis points. So what does it mean? That for each 100 rupees the company is able to get under the ARR revenue, 76 paisa stays with them. I think I haven't like looked into this, but this looks a good number for me. So it does show that this is not just managing majorly the debt mutual funds, but also a lot of it is equity mutual funds. So overall, that's a great number for me.